Thank you, Michael.
You're welcome, Charlie.
That was terrific. Do I have any time left?
Yeah.
Okay, good. It's good to know. Good to know. Welcome, everyone. This is terrific. As Mike said, a new venue. We filled the place up. We hope to fill it up every year, but thanks for coming. We appreciate your time and interest. Obviously, it's your money. You're probably not going to have anything more else that you're more interested in at this point, but thanks for being here. As Mike said, my part of the presentation is pretty much the same every year. I give you sort of a report card on how we did last year. I try to cover some of the issues that created what happened last year and might create what happens in 2018, and then give you our sort of look at what we might see happening for the new year. So with that, let's get started. Okay, last year we said we thought the U.S. economy, as measured by real gross domestic product, could grow we'd see at least 2 quarters of 3% or better growth in the year 2017. We thought deregulation prospectively with the new Trump administration would revive the animal spirits of business. We would see domestic capital investment pick up. That is, the spending that companies do to try to grow their businesses would increase in 2017. We thought corporate earnings could grow 11% versus 2016. We thought we would see better revenue. We potentially thought there might be a hit to importers because of the talk of a border adjustment tax. That turned out to be nothing to worry about. We thought S&P earnings in aggregate, that is the aggregate profits of the S&P 500, could hit $132 per S&P share. We had a target of 2376 on the S&P, which was 6% above the level of the year-end close 2016. We thought the biggest risk was protectionism. We thought that a new Trump administration might come in and immediately lay down some fairly onerous trade laws or regulatory changes that might hurt trade. Turned out that didn't happen. There was a lot of talk, but not a whole lot of action in the year. Wild cards, our commander in tweet, trade war. As I said, China pushes back against any potential trade issues, Eurozone breakup, or maybe the Fed might be more aggressive at removing all their monetary accommodation in the economy. Turns out that did happen, but it really wasn't an issue for either the stock or the bond market in the year. And I'll talk about that a little bit as well. So that was last year. This photo, I went out and looked. It's a photo I used last year. I went out and looked for the most flattering photo I could find of our president. I know there are all sorts of political opinions in the crowd, so I'm trying to walk right down the middle as best I can, and you'll see why here in a minute. But I found a great quote from an ancient Greek poet. The fox knows many things, the hedgehog one big thing. And what does that mean? What do you mean by that? In my opinion, President Trump really has one central idea. I'm not even sure it's an idea in his mind, but he has one central core sort of driver in most of the things he does, and that is to make the economy stronger. And most of his day-to-day efforts can seem to be off track and seem to be coming from out of left field or who knows where. But I think particularly when you look at the people that he has put in power in the cabinet, the efforts of his team pretty much are directed towards making the economy better. And that really is the central idea, the one thing that Trump and his administration, I think, have been focused on, and I think they're going to continue to focus on. So that's the sort of the overarching theme. Here's what happened in the year. We were right on as far as growth is concerned. 3 quarters of growth better than 3% in the year. Fourth quarter numbers are not in yet. They'll be out tomorrow. We'll know what real GDP growth was for the fourth quarter tomorrow morning. We had major sentiment indexes, that is the NFI, National Federation of Independent Business, the ISM Index of Corporate Sentiment. Major business indexes hit 10-year highs. Corporate sentiment improved markedly in the first half of last year in particular. Business investment increased 5% through November, best year-over-year growth since 2007 in corporate capital spending. We thought S&P earnings would come in at 132. They came in right at $132 per S&P share. We misjudged the timing on the Tax Cut and Jobs Act, the TCJA. It came very late in the year. There was no border adjustment tax. Essentially, Trump got half a loaf, and by that I mean he got deregulation, significant deregulation across the board in cabinet departments, and he got a tax cut at the end of the year. The Obamacare was punted, and infrastructure is still to come. We're hearing, in fact, the Trump's infrastructure plan was leaked today, so we'll see a whole lot more, I'm sure, of that in the press. It was a business-friendly outcome. We got 2 out of 4 of the Trump agenda items, and the stock market obviously did very well. Our price target was 2376. The S&P 500 ended the year at 2674. So we were low by 12% in terms of our guess from where the S&P could end up. Obviously, your portfolios did quite well, many of them far better than 12%. We saw the PE multiple, the price-earnings multiple, which basically is the value that the market is putting on a dollar's worth of earnings, expanded to 20 times. We saw almost no sign of imminent protectionism, and that really goes to the issue of watch what Trump does rather than what he says, because about 80 to 90% of what he says just goes off into the ether and never really becomes reality. We also thought we might see volatility. We saw the exact opposite. We saw market volatility at all-time historic, for the modern U.S. stock market, the least volatile year in market history. The market basically went up in a straight line. So that was the what for 2017. Here are some of the numbers and some of the sort of the graphics behind what happened. This is a graph of an aggregate survey data of business, small business, big business sentiment. The black line basically shows you business sentiment took off right after the election, and these numbers spiked beginning in December of 2 years ago, right after the November 2016 election. So businesses became a whole lot more optimistic about the future and in an accelerating way throughout 2017. The red line is GDP. And so there's this big sort of gap that we've opened up between what businesses think the future looks like and what the past GDP results or growth results have looked like. And if the future looks at all like the past, we're going to see much better growth because businesses feel a whole lot better about their futures. So sentiment's way better, and these sorts of surveys are saying boom ahead. The actual industrial production numbers, it's not just surveys, but industrial production is also hitting the highest levels in over a decade. Industrial production is probably the best measure of health in the manufacturing economy. It tells you month to month, utilities, factories, just what the exact total output is for the manufacturing side of the economy in the U.S., and we've just broken out to a new high in terms of industrial production here in December, all-time high. Also, we've been seeing, sort of on an anecdotal basis, corporate America is stepping up to the plate in terms of changing their behavior with regard to investment. And really, this should be the next step in the process. And I'm using Apple as sort of the poster child for this change. Apple has $250 billion parked overseas. They estimate if they repatriate 100% of it, it would have a $350 billion cumulative economic effect in the U.S. over the next 5 years. They will pay $38 billion in taxes, largest single tax payment in U.S. history. Compare that with the rest of the U.S. companies that have a total of $3 trillion overseas. If the same ratio that Apple used to calculate the economic effect of their repatriating $250 billion applies here, just repatriating half of this $3 trillion would have a $2.1 trillion cumulative economic effect in the U.S. in the next 5 years. That's 0.2% of real GDP per year each of the next 5 years. $400 billion economic effect each year from just repatriating half of this cash that's held overseas. It's a material number. It moves the needle, so to speak. And we've seen more than 200 members of the S&P 500 have announced wage increases, bonuses, stock awards, increased capital spending, basically a change in their behavior from the last 8 to 10 years. If you remember back in the period 2014 to 2015, the word that was on the lips of every single corporate executive was uncertainty. Uncertainty, I wish I had a nickel for every time I heard that in the business press between 2014 and the end of 2015. Well, that word is pretty much gone. And so the behavior of corporate America has changed. And that is creating good things for the economy. So, what's it mean for 2018 in terms of real GDP growth? This is a graph of annual gross domestic product growth going back to 1990. And as you can see in the early years of this graph, and the orange line is 3%. Okay? You can see going back the early years in the graph, 92, 93, 94, 95, it was common for us to have years where we were well over 3 and even into the 4s in terms of annual real economic growth. Those sorts of examples were few and far between the last 10 years. It looks like 2017 we will, depending on the number we get tomorrow, and look for it, if we get a number for real GDP growth in the fourth quarter of last year that's north of about 4.2%, that'll mean the year 2017 gets above 3%. First time that will have happened since 2005. So again, evidence of real change in the system. Evidence of real change. So what are the risks? What could derail a better economy? Well, from our perspective, risk number one is that we get a move up in interest rates that's too rapid, too severe, that throws off the continuity of bullish thought. And this is simply a graph of the long-term bond rate over the last 35 years. Basically, interest rates have been going down for 35 years. And in the last 17 years, we've had 4 examples of market pundits calling the end of the bull market in bonds, basically saying interest rates aren't going down anymore, they're going to start going up. And as you can see, in 2000, 2010, 2015, we've had examples where the market was wrong, where the prognosticators were wrong. The market's always right. The prognosticators were wrong. And so we've seen a big move up in long-term interest rates just over the past couple of months. So the big question everyone has is, has the move up in long-term interest rates over the past month or so, does that finally indicate that this time is the charm? That interest rates are going to move up? And that a potential increase in interest rates could drive down price-earnings ratio? It's a fairly simple relationship. When interest rates move up, that makes stocks less valuable, no matter what they're earning. So if long-term interest rates are actually breaking out of this long-term downtrend that they've been in for 30-some years, that could be problematic for stocks because investors would value a dollar of earnings at a lower price. So that's an important risk factor that we're monitoring closely. So what do we see for 18? As I said, steadily better U.S. GDP growth. I think we'll have at least 4% growth quarter in 2018, maybe 2, depending on how much corporations really are going to be able to increase their investment rather than focusing on stock buybacks and dividends. And by the way, an improving economy isn't necessarily going to be the best thing in the world for investors. If you think about it, investors have been paid over the last 8 to 10 years. It's the real economy, wages, continued employment growth that really has been lagging. And I think if that changes, it would probably be a whole lot better for our society as a whole if we were to begin to see better wage growth. The populist wave that we saw in 2016 might not be as strong. So, benefits from tax reform, deregulation, and improved corporate capital spending. We expect corporate earnings to grow 14% versus 2017, still a very, very healthy growth rate. A good portion of the growth in corporate earnings in 2017 will come from tax reform. About $5 of the $151 estimate we have for S&P 500 earnings in 2018 is from tax reform. Putting a 19.5 multiple on that gives us a target for the S&P of 2945. The S&P closed today 4 or 5% underneath that number. So the S&P is already up 7% this year. Okay? That's, if there's a news flash from this presentation that you need to take home, the S&P has already earned 80% of what it earns in a normal year, and this is January 25th. Okay? So our target of 2945, we're 70% of the way there already. Okay? And as I said, the biggest threat to PE multiples, referred to a minute ago, is higher interest rates. Higher interest rates mean lower PE multiples, which means potentially lower stock prices. What are the wild cards? We've seen a lot about it in the press this past week. If NAFTA does fail and the Canadians and the Mexicans decide that they're going to respond in kind in terms of tariffs or trade shutdown, that could be an issue. There is some trepidation already about midterms, although I've just seen in the last couple of days that the polling results regarding Trump's efforts on the economy are materially improving, and you would expect that. So there is some trepidation about a potential change at the midterm. And of course, we could get Kim Jong-un on Twitter. For those, we could have a nice Twitter battle going here between Trump and Kim Jong-un. So that's what we see.
Thanks, Charlie.
All right, Mike.